Let's bring in Charles Schwab, Chief Global Investment Strategist Jeffrey Kleintop. Another pretty benign read, which is what the Fed and the market have been craving. We've gotten a few of these in a row now in terms of monthly numbers. Can the market still celebrate better or in-line inflation reports, or are we past that?
I think we're getting past that. The interest rate futures market is now overwhelmingly confident, 90% or higher, in a September rate cut by the Fed, and those that have already started a cut, like the ECB and the Bank of Canada and the Swiss National Bank, and all of them expected to even cut one more time later this year. Now, I think it's more likely than not, and confirmed by the data today, including the softer services data, but are we 99% or more sure that inflation won't remain resilient this summer in the face of, we're seeing shipping costs for goods nearly back to their pandemic highs. Services costs still remain relatively robust, around 5%. And not to mention the potential for rising tariffs lifting costs all point to maybe some reason to be less than 100% sure of a cut in September. But that is a risk to the market. If inflation does appear to be more stubborn between now and September, some of that market broadening may reverse on the idea that the Fed might still have to stay higher for longer.
So you're not buying the broadening either. You think what? Stick with the big cap tech? What looks good to you then?
No, I am actually in the broadening camp. And one of the things that I make points about inflation, but I do think we're on this path of easing rates. Already we've started to see this in Europe. That's my favorite area to take a look at. The earnings picture is actually brighter for European stocks than U.S. stocks. We've seen analysts now put earnings for the Europe Stock 600 index. Their growth rates over the next 4 quarters are in line with the S&P 500. First time we've seen that in a long time, but trade at a PE of 13 versus the S&P's 21. So I think European stocks are positioned to outperform in the second half of this year with improving earnings growth, competitive, much more attractive valuations, and rate cuts already underway.
Jeff, the outperformance of the U.S. market as measured by the S&P 500 has obviously been very pronounced. But if you were to look at the S&P equal weighted index, it has looked a whole lot more like non-U.S. equities, right, in the last year or so. They've tracked really well. In the last little while, maybe some U.S. outperformance in terms of the equal weight over the global aggregate. Is that something that you think is relevant in terms of growth expectations or Fed rate cuts or political concerns, or is it noise?
No, I think it's very important. I think starting to see the market broadening is critical, and I think it's about time we've seen something like that. Look, there are plenty of issues right now that might be weighing on the tech sector, from seasonality and earnings outlooks that have been underwhelming from Alphabet and Tesla, maybe economic data missing some expectations over the past few weeks, and election uncertainty. But I think it's this yen carry trade that's in the background as well. Going long tech and short the yen have been two very crowded trades in recent years. I think we're starting to see that reverse, weighing more on tech, broader outperformance among other sectors, and that's helped to contribute to broader performance outside the U.S.
You see that continuing, yen strength?
I do. In fact, I think the Bank of Japan could surprise next week. Of course, they meet on the 31st. And not only maybe a 10 basis point rate cut, but maybe a hike of 10 basis points, maybe 15 along with the plan for QT, tapering asset purchases over the next couple of years. I think that could surprise on the upside, causing the yen to strengthen further and maybe even deepening the tech sell-off.